Hello everyone and welcome. My name is Bob Durante and I'm a Senior Director at S&P Global Market Intelligence, managing the America's Risk Solutions team for Global Risk Services. It's my pleasure to moderate today's video, Lessons Learned from 3 Decades of Global Project Finance Defaults. On April 13th, S&P Global Market Intelligence hosted a webinar on developing a creditworthiness framework to fund energy project finance in Mexico, which we hope you had a chance to watch. The event prompted a lot of interest in this topic and credit risk in project finance in general. Given the amount of questions we've been receiving from our clients and our wider audience, we were inspired to take this opportunity to come to the S&P studio to share some greater insight on the broader topic from the perspective of our Global Risk Services team. First, I'd like to briefly introduce my colleagues. First is Eduardo Alves, Associate Director at Global Market Intelligence, focusing on delivering risk management solutions for financial institutions of varying sizes and specialties. For those who listened to the webinar, Eduardo should sound very familiar to you. I also like to introduce Rad Lukic, Director, S&P Global Market Intelligence. Rad is currently the analytical lead in the team on developing and managing credit risk scoring methodologies, including project finance. And finally, I'd like to introduce Arnold Javero, Associate Director responsible for credit assessment, importantly default and recovery studies within the unrated global project finance market. Thank you, Eduardo, Rad, and Arnold, for joining us today. Now, let's get started. Today's agenda will focus on 3 broad topics. First, I would like to talk about the data we use to determine the lessons learned from 3 decades of global project finance defaults. Second, when we drill down into the data, how can we apply those lessons learned in the infrastructure space and other project finance sectors globally? Third, identify and provide insight into a best practice approach to determining the default risk for project finance. Let's start with Arnold. You manage and analyze a gold mine of project finance data, 3 decades worth of data. Tell us about it.
Okay, Bob. As of 2014, the database, which supports our annual project finance default and recovery study, is made up of the aggregate information of close to 8,000 unrated project finance deals originated globally from 1980 to 2014. The size and breadth of the data set allows us to calculate metrics such as annual and marginal default rates, as well as identify performance trends across regions and industries.
8,000, that's massive. Roughly how much of the project finance marketplace does that represent?
It represents upwards of about 75% of the syndicated project finance loan market.
Rad, you've been risk scoring project finance transactions for nearly a decade. Where would you start to better understand why projects default?
Right, so our scorecard methodology for risk scoring of project finance is based on the S&P Project Finance Framework methodology from 2014. And that framework is divided into 2 risk phases. The key steps are going to be summarized on this chart here. But in terms of the construction risk first, we first focus on the technology and construction itself to differentiate those projects that are more complex and that have a heightened construction phase default risk. When we assess the operations phase, we focus on performance risk, market, and country risk, and of course the debt service coverage ratios from our financial forecasts. So depending on where the individual project risks are identified, for example, you can have pricing of the output linked to commodity market pricing without any contractual agreements, and then this market risk component is going to be the one driving up the default risk.
Great. Eduardo, what jumps out for you in terms of the highest value-added data in the Project Finance annual study?
Sure, Bob. So this annual study contains a multitude of valuable information. The first thing that comes to mind is something that Arnold mentioned, the sheer volume of the data. So the study covering roughly 75% of the unrated project finance universe. And the geographic dispersion of the data also allows for much more comprehensive view of the global project finance performance. But one aspect that many clients view as a big added value is the recoveries information.
Arnold, can you talk about the sector coverage in the study?
Sure, Bob. Each deal is categorized into one of 10 industry sectors. The top 3 industries, power, infrastructure, and oil and gas, make up about 80% of our total database. These sectors represent 73% of all the underperforming deals that we've observed.
Well, now we will transition to the second part of our discussion, drilling down into the data to understand how we can apply those lessons learned in the infrastructure space and other sectors globally. Eduardo, in relation to your recently hosted webinar, do you see project finance increasingly becoming the most popular way to finance energy infrastructure in emerging markets?
Interesting. So as we discussed during the previous webinar, there are many opportunities in the energy sector, right? Mexico was a great example due to the recent policies to liberalize private investment in the oil and gas sector. But in general, the opportunities lie across all emerging markets because of the huge need for investment in infrastructure coupled with the ever tighter government budgets. So project finance, more specifically PPPs or public-private partnerships, could be used to finance the majority of this infrastructure gap.
That's interesting. Okay, Arnold, infrastructure is one of the 10 sectors contained in the data.
Right.
What are some of the examples of infrastructure projects, and relative to other sectors, how has that sector performed?
Bob, representing about 29% of the database, infrastructure is further segmented into 5 subsectors, including transportation, public buildings, ports and terminals, water, waste and utilities, and sort of infrastructure other sector. Since 2000, the sector's annual default rate had averaged about 0.6% until a significant increase in 2009 to 1.7%. Sector defaults peaked to 2.2% in 2010 and has since improved to 0.5%. So it's a pretty stable sector.
Interesting how it spiked after the crisis.
Yeah.
Red, what scorecard do your clients apply for scoring infrastructure and project finance?
Right. So, well, it really depends on the nature of the exposure. For assessing the creditworthiness of infrastructure companies, S&P corporate scorecards are going to be applied to entities in the transportation, regulated utility sector, for example, such as water, gas, and electric producers. We also then apply our project finance scorecard to those infrastructure projects that are structured on a non-recourse basis and meet our project finance criteria.
Makes sense. Arnold, when reviewing the 30 plus years of data, are there regional patterns? A question we always get, are emerging markets materially riskier than developed markets?
Okay, I mean, I think the analysis, particularly the annual default rate, suggests historical downturn periods and default volatility patterns across regional segments. Overall, I think there's little evidence that indicates emerging market projects are materially more risky versus comparable deals in developed markets.
Great. Rad, how much does country risk play into project finance creditworthiness?
Right, that's a good question. I mean, obviously, it's a big part of our framework for project finance. But for example, infrastructure projects, they're typically either directly or indirectly funded or supported through a government. So they will face significant exposure to regulatory and political risk, making it a sort of key part of our scorecard as well. So if you take the renewable sector, for example, that's especially reliant upon government policies and subsidies. And then, of course, another component of our country risk is the political risk component. That's going to uncover the ways in which government can define policy and the likelihood of it changing. So, for example, political focus on delivering affordability to consumers, especially pre-election time, I would say. That's going to be one example where some projects are going to be exposed to unforeseen events and maybe even tariff changes.
Excellent. Arnold, here's a tough one. With over 600 defaulted projects, what are the more common reasons why these projects default?
Thanks, Bob. Regional and industry analysis suggests that almost 75% of defaults occur within the first 5 years after financial closing. This pretty much indicates that there is probably a critical high-risk period when a deal is more vulnerable to credit default. Closer project-level analysis indicates that the risk is most acute at the point when a project starts to transition to operations and is confronted by a confluence of risk events, such as market or industry downturns, changes in regulation, as Brad points out, cost overruns in construction, etc. Essentially, what's happening here is it alters the industry operating environment for which the deal was structured. While projects are expected cash flows are modeled to withstand market and operational downside scenarios by including dedicated liquidity or credit protection features. Once these buffers are depleted, restrictions on asset sales or change in strategy means a stressed project has limited recourse options.
Great. And a similar question to you, Eduardo. What would you suggest are some of the lessons learned from reviewing over 3 decades of project finance defaults?
Right. So the first thing I would like to point out is that the annual project finance study included roughly 350 projects in 2014 and 700 for 2007, meaning the current project finance activity is roughly half of what it was before the most recent financial crisis. So from my perspective, many of the issues that we're discussing here today regarding specific credit risk factors for product finance can be used to rebuild the eroded confidence needed to jumpstart global product finance activity. Right. So now, on the specific lessons learned from the annual product finance study, I would point out that the 10-year cumulative default rate for project finance is in line with the 10-year cumulative default rate for BBB rated corporates. So for me, this is a great insight, as there is general perception that project finance does not usually reach this low investment grade risk quality. So further to this is the fact that project finance exhibits a very strong average recovery rate of roughly 77%.
Oh, that's good.
Let me add to that. I think also the dispersion or the distribution of the recoveries, it's basically barbell shaped. So essentially what will happen is borrowers will either get over 90% or very low percentages in terms of recoveries.
Interesting.
All right, great. It's time to transition to the third and final phase of today's discussion. Identify and provide insight into a best practice approach to determine the default risk for project finance. Over the past 10 years, we have conducted dozens of scorecard and model validations, including project finance. Rad, so what are some of the key takeaways that we can share, especially around project finance risk assessment approaches?
Sure. Yeah, well, there's quite a few, Bob, takeaways. But first, project finance, I have to say, is often the most complicated and misunderstood asset class from a risk modeling perspective, right? And we have seen analytically even unacceptable examples where clients have run their project finance exposures through a corporate framework or scorecard. On the other hand, they have built some in-depth scorecards, but commingling the construction and operations phases or simply just missing some key risk drivers. So it's a challenge, and the challenge with project finance is that the critical credit factors vary depending on the type of project or even subsector. Renewable energy, geothermal versus solar versus wind is going to be quite different.
Now, Rad, you already mentioned that when we use a corporate versus a project finance approach, but why is it so important to distinguish between construction and operations?
Right. So, as Arnold mentioned, we can have that initial ramp-up phase as the phase where the heightened risk actually is. But also, we believe that the risk assessment of a project, because of that, has to reflect the credit quality of the project during its weakest period until the obligation is repaid through project cash flow. as a result, our project initial risk profile is going to be the lower of the construction or operations phase assessment. And of course, if the project has completed construction, then only the operations phase risk is going to apply.
Great. Now, Eduardo, when conducting our validations, what are some of the key risk drivers that would predict defaults that were often missing or misunderstood?
Right, so as you just mentioned, we had the opportunity to perform model validation, including of project finance related risk rating models for many different clients. This gives us this privileged position to see various approaches to tackle the same issue. I can say that one factor consistently missing is the counterparty dependencies for the construction completion. So often we see models that take into account the direct dependency to a counterparty, for example, but not how easily replaceable this counterparty is in the event that they become unreliable.
Great.
Another factor I would point out is the inconsistent approach to including and capturing country risk as opposed to sovereign risk in the analysis, something that
Great.
Brad pointed out.
And Arnold, could we get your perspective on the same question?
I'm going to take a little bit of a separate or different track on the answering the question, Bob. As Rad pointed out earlier, project finance is one of or the most complicated sector to manage, given that project structures and operational fundamentals are inherently unique. So in addition to the factors Eduardo mentioned, we've seen models that often include market exposure risk, such as changing market prices and demand, capital expenses. So I'd like to point out, or basically I'm trying to stress the fact that the need to monitor ongoing changes as opposed to just one point in time. And the scorecard gives you the opportunity and the framework to get this done.
Given the complexity of project finance, why is proper documentation so critical, and what would regulators look for?
Oh, right. Yeah. So here we go back to one of our favorite regulatory guidelines, the U.S. SR 11.7 guidance, and basically it's outlined that developing and maintaining strong governance over the model risk management framework is fundamentally important. And strong governance, as we know, also includes documentation of model development and validation that's going to be sufficiently detailed to allow parties unfamiliar with the model to understand how the model operates and understand what the limitations and assumptions used were.
All right. Well, that's all for today. To learn more about how our credit assessment scorecards or project finance data can help you, please fill out the form that will appear on the screen. On behalf of Rad, Eduardo, and Arnold, thanks for watching.